On a foggy morning in March 2023, a rusted Aframax tanker called the Andromeda Hope sat anchored 12 miles off the coast of Greece. Her hull bore scars from 3 decades at sea. Her flag Gabon was new, painted over what had once been Liberian registry just 4 months earlier. Her ownership, a shell company in Dubai, owned by another shell company in the Marshall Islands. Her cargo, 700,000 barrels of Russian Urals crude bound for India. The tanker was dark. No transponder signal. No public insurance disclosure. No Western bank touched the financing. She was invisible to the system that had once governed global oil flows. And she was not alone. By mid-2024, over 600 vessels like the Andromeda Hope formed what analysts now call the Shadow Fleet, a parallel maritime economy built to evade the most ambitious sanctions regime ever imposed on a major oil exporter. These ships carry roughly 1.8 million barrels per day of Russian crude and refined products, worth approximately $120 million per day at current prices. They sail without Western insurance, operate under flags of convenience, and vanish from tracking systems for weeks at a time. This is not smuggling in the traditional sense. Russia is not hiding its oil. It is exporting it openly, just outside the rules. And the West is learning an uncomfortable truth. You cannot sanction what you cannot see. When Russia invaded Ukraine in February 2022, the West's response was swift and surgical. Freeze assets, cut off SWIFT, isolate the central bank. But one lever remained untouched for months: oil. Europe was addicted. Russia supplied 27% of the EU's crude and 46% of its natural gas. Cutting it off completely would spike prices globally, punish Western consumers, and hand Putin a propaganda victory. So the architects of Western policy, led by U.S. Treasury Secretary Janet Yellen, proposed a clever middle path. In December 2022, the G7 unveiled the oil price cap, a 60 tarid per barrel ceiling on Russian crude. The mechanism was elegant in theory. Western countries would still allow Russian oil to flow, but only if it traded below the cap. Crucially, they would ban Western companies, insurers, shippers, traders from handling Russian oil sold above the cap. This was the carrot and the stick. Russia could keep exporting. Global supply would remain stable, but Moscow's revenue would be capped. The war chest would shrink. The myth was seductive. Sanctions could be surgical. You could limit revenue without stopping the flow. Within 6 months, that myth shattered. Let's start with the autopsy of the price cap itself. Case Study 1. The Vanishing Premium. In early 2023, Russian Urals crude was trading at a $30 discount to Brent, well below the 60 tarid cap. Victory, declared Western officials. The cap is working. But look closer. The discount wasn't caused by the cap. It was caused by logistics. European refineries had stopped buying. Russian oil now had to travel farther to India, China, Turkey, adding shipping costs and time. The discount reflected distance, not sanctions. By late 2023, something strange happened. The discount narrowed. Urals crude climbed back toward $55, then $58, hovering just below the cap. Why? Because Russia had built a workaround. Enter the Shadow Fleet. In 2022, roughly 80% of the global tanker fleet was insured by the International Group of P&I Clubs, a cartel of Western insurers based in London. The price cap's leverage came from this choke point. If you want our insurance, you follow our rules. Russia's response was simple: stop using Western insurance. Between December 2022 and June 2024, over 400 aging tankers were quietly purchased by opaque buyers, often at inflated prices. These ships were reflagged to jurisdictions like Gabon, Cameroon, and Palau. Their insurance, provided by obscure Russian and Asian companies with names like Ingostrak and Sovcomflot Insurance. Their legitimacy? Unclear. Their leverage? Zero. The West had assumed that maritime insurance was a bottleneck. It turned out it was a preference, and Russia was willing to trade safety for sovereignty. Here's where it gets murky. The Shadow Fleet doesn't just move oil, it transforms it. A tanker leaves Novorossiysk with Russian Urals. It sails to a floating transfer point off the coast of Greece, a ship-to-ship transfer zone. There, the oil is offloaded onto another vessel, often mixing with non-Russian crude. The new tanker sails to India. The origin is now blended. The price? Negotiable. This is what I call the fog premium, the hidden markup charged by middlemen who navigate the gray zone between legality and enforcement. Turkish traders, Greek shippers, and Dubai-based commodity firms now extract 5 to 10% margins on every barrel they help obscure. The Shadow Fleet isn't just a logistics network, it's a profit center. And here's the kicker: some of that oil eventually ends up back in Europe, refined in India, re-exported as diesel, stamped product of India. The cap didn't stop the flow, it rerouted it and added costs that Russia is passing on to buyers willing to pay for opacity. So how does this actually work? What is the engine of the Shadow Fleet economy? I call it the risk as currency model. In the old world, risk was minimized, ships had insurance, flags had credibility, contracts had enforcement. In the new world, risk is the product being traded. Here's the structure. Layer 1, the invisible owner. A tanker is sold by a legitimate Greek shipping company to a shell entity in Dubai.
That entity is owned by a trust in the Marshall Islands. The beneficial owner? Unknown. This is legal. Maritime law allows it. Layer 2. The phantom insurer. The ship is insured by a company registered in Russia or India. The policy coverage? Allegedly $1 billion. The company's actual assets? Maybe $50 million. In the event of a spill, there is no payout. But there is paperwork, and paperwork is enough to satisfy port authorities in places like Chennai or Fujairah. Layer 3. The dark sailing. The ship turns off its AIS transponder. Legally, this is required only in certain waters. In practice, these ships go dark for weeks. Satellites track them using synthetic aperture radar, but that data is expensive. Most port authorities don't check. Layer 4. The fog transfer. The ship meets another vessel in international waters. The oil is transferred. No port, no customs, no record. The receiving ship sails to India under a different name, a different flag, a different manifest. Layer 5. The negotiated price. The oil trades around the $60 cap, sometimes 58, sometimes 62. The price is negotiated bilaterally between buyer and seller. There is no transparent benchmark. The cap becomes friction, not a ceiling. This is the real mechanism. The shadow fleet doesn't break the cap. It makes the cap irrelevant by operating in a space where enforcement is impossible. So what are the new rules of this game? Rule 1. Sanctions are signals, not walls. The Treasury Department has sanctioned over 100 shadow fleet vessels by name. Each time the vessel is reflagged within weeks. The sanction is a signal, a warning to Western banks and insurers, but it doesn't stop the ship, it just raises the fog premium. Rule 2. The market adapts faster than enforcement. In June 2024, the US announced it would target tankers that repeatedly violate the cap. By August, those tankers had been sold to new owners, renamed and reinsured. The adaptation cycle is 60 days. Enforcement cycles, 6-12 months. Rule 3. The bottleneck isn't oil, it's data. The real war is over visibility. The US is now using satellite firms like SpaceNo and Orbital Insight to track dark tankers. But China and India, Russia's biggest buyers, have no incentive to cooperate. They don't share port data. They don't verify insurance claims. The opacity is a feature, not a bug. Rule 4. Sanctions have distributive effects. The price cap didn't hurt Russia as much as hoped, but it did hurt smaller players. European refiners lost access to cheap Russian crude. African and Latin American buyers now compete with India and China for non-Russian supply, driving up prices. The shadow fleet created a two-tier oil market, one for compliant actors, one for everyone else. Rule 5. The endgame is negotiation, not victory. No one thinks the shadow fleet is sustainable forever. These aging tankers will break down. Insurers will face catastrophic claims. Environmental disasters will force accountability. But until then, the fleet serves its purpose. It keeps Russian oil flowing, while the West claims moral high ground. The new rule is this. Sanctions cap revenue by adding friction, not by stopping exports. And friction is expensive for everyone. Here's what keeps me up at night. The shadow fleet proves a larger point. In a multipolar world, Western rules are optional. For 75 years, the US dollar, London insurance, and SWIFT gave the West the ability to enforce compliance globally. But the shadow fleet shows that compliance is now a choice, and if you're willing to pay the fog premium, you can opt out. This has implications far beyond Russia. What happens when China decides it wants to move money outside the dollar system? What happens when Middle Eastern oil exporters decide they'd rather trade in yuan? What happens when the infrastructure of global trade, insurance, shipping, payments splits into parallel systems, one Western, one not? The shadow fleet is a prototype. It's inefficient, it's risky, but it works. And if it works for oil, it can work for semiconductors, rare earths, or anything else the West tries to restrict. The uncomfortable question is this: did the oil cap weaken Russia, or did it teach the world how to evade the West? Because if it's the latter, the shadow fleet isn't just about oil, it's the blueprint for the next global economy. One where rules are negotiable, borders are porous, and the fog is thicker than anyone anticipated. And the scariest part, the West doesn't have a plan for what comes next.